What if I told you that the world's largest asset manager just made a move so large, so coordinated, and so quiet that by the time most people understand what happened, the consequences will already be irreversible? BlackRock controls over $10 trillion. That's more than the GDP of every country on Earth except the United States and China. And right now, they're shifting that capital in a direction that has nothing to do with what you're being told on financial television. This isn't speculation. The Securities and Exchange Commission filings are public. The pattern is clear. And the people who understand what this means are not talking about it on CNBC. They're moving. Here's what you need to understand first. BlackRock doesn't invest like you do. They don't pick stocks hoping they go up. They don't bet on trends. BlackRock builds infrastructure around inevitability. They position capital where policy, regulation, and central bank coordination guarantee outcomes. And when an institution that size begins rotating trillions of dollars out of traditional equity exposure and into very specific sectors with regulatory tailwinds and government backing, that's not portfolio management. That's advanced knowledge of where the system is heading. The question isn't whether this shift is happening. The question is why you're only hearing about it now. Let's start with what they're actually doing. Over the past 18 months, BlackRock has quietly reduced its overweight positions in large cap technology, consumer discretionary, and financials. At the same time, they've been building unprecedented exposure to infrastructure, renewable energy, defense contractors, and commodities with direct government subsidy structures. This isn't a hedge. This is a wholesale reorientation of where they expect returns to come from over the next decade. And it's not just BlackRock. Vanguard, State Street, and several sovereign wealth funds have mirrored this behavior when the three largest passive asset managers in the world move in the same direction at the same time. That's not coincidence. That's coordination around a shared understanding of what's coming. Now here's where it gets uncomfortable. The sectors BlackRock is moving into are not free market sectors. They are policy-dependent sectors. Infrastructure spending is determined by government appropriations. Renewable energy subsidies are set by legislation. Defense budgets are controlled by geopolitical priorities. What BlackRock is telling you, without saying it out loud, is that the next phase of wealth accumulation will not be driven by innovation or consumer demand. It will be driven by the reallocation of public capital into private hands. This is the fusion of state and corporate interest. And it's not a conspiracy. It's just how modern capitalism works when central banks run out of tools and governments run out of revenue. The reason experts are worried isn't because BlackRock is wrong. It's because if BlackRock is right, it means the system you've been told to invest in, the system based on earnings, growth, productivity, and market efficiency, is being replaced by something else entirely. A system where returns are guaranteed not by performance, but by proximity to policy, where the winners are chosen in advance, where capital doesn't flow to the best ideas, but to the most politically connected infrastructure. And if you're not positioned in those sectors, you're not early. You're simply not invited. Let's talk about what this means for inflation, because that's the part nobody is connecting. When you move trillions of dollars into sectors that are supply-constrained, labor-intensive, and dependent on physical commodities, you're not just buying assets. You're buying the inputs to everything else: steel, copper, lithium, concrete, energy. These are not speculative plays. These are the base layer materials required to build the infrastructure BlackRock is betting on. And when the largest pools of capital in the world begin competing for those inputs, prices don't go down, they go vertical. This is not an inflation hedge. This is the creation of inflation. And the people making this move are the same people advising central banks on monetary policy. Think about that. Now here's the mechanism most people miss. BlackRock doesn't just buy and hold. They use their scale to influence the very markets they invest in. When BlackRock builds a position in renewable energy, they simultaneously lobby for renewable energy mandates. When they enter infrastructure, they push for infrastructure bills. When they accumulate commodities exposure, they advocate for supply restrictions under the banner of ESG and decarbonization. This isn't corruption. It's vertical integration of capital and policy. And it works because the line between public and private interest has been erased. BlackRock's CEO sits on economic advisory councils. Their strategists write white papers that become Federal Reserve policy. They don't predict the future. They design it. And here's what makes this particularly dangerous for the average investor. You are being sold a narrative that doesn't match the positioning of the people selling it. While retail investors are told to stay diversified, stay calm, stay invested in index funds, the indexes themselves are being quietly rebalanced to favor the sectors BlackRock is rotating into. The S&P 500 you think you own today is not the same S&P 500 you owned 5 years ago. The weightings have changed, the sector exposure has changed, the risk profile has changed, and none of that required your consent. You're being moved into the same trade as BlackRock, but at a higher price, with worse timing, and with no understanding of the exit strategy. Because BlackRock has an exit strategy. You don't. Let's talk about what happens when this shift accelerates. Right now, we're in the quiet accumulation phase. Prices haven't moved dramatically yet because the capital is being deployed slowly, carefully, without triggering algorithmic momentum or media attention. But there is a tipping point. And that tipping point happens when government spending programs are announced and the money starts flowing. Infrastructure bills, green energy mandates, defense authorizations. The moment those fiscal taps open, the assets BlackRock is holding will reprice violently. Not because of earnings, not because of demand, but because the government just guaranteed the cash flow. And when that happens, retail investors will do what they always do. They'll chase. They'll buy at the top, and they'll hold through the collapse when the subsidies end and the infrastructure is built and there's nothing left to invest in. Here's the part that should terrify you. This model only works if currency continues to debase. If the dollar holds its value, none of this makes sense. Infrastructure projects become uneconomical. Commodity prices stabilize. Renewable energy can't compete without subsidies. But if the dollar weakens, if inflation stays structurally higher than the Fed admits, if real yields stay negative, then everything BlackRock is doing becomes the only rational trade. And that's the unspoken assumption embedded in this positioning. BlackRock is betting that central banks cannot and will not allow deflation. They're betting that the political cost of austerity is too high. They're betting that governments will print, spend, and stimulate until the currency itself becomes the variable that adjusts. And if they're right, holding cash is not safety. It's slow confiscation. Now let's talk about you, because this isn't just a macro story. This is about the transfer of wealth from the unprepared to the positioned. If you're holding cash, you're losing purchasing power. If you're in bonds, you're getting paid in currency that's worth less every year. If you're in traditional equities without commodity or infrastructure exposure, you're invested in the last cycle, not the next one. And the gap between those two realities is widening every quarter. The people who understand this aren't waiting for confirmation. They're not waiting for headlines. They're moving now, while the assets are still mispriced, while the narrative still sounds crazy, while the crowd is still calling it a conspiracy theory. Here's what the shift really signals. It signals the end of the financialized economy and the return of the physical economy. For 40 years, wealth was created by financial engineering, by leverage, by asset price appreciation disconnected from production. That era is over. The next era belongs to the people who control the physical inputs to economic activity. Energy, metals, food, water, infrastructure. These are not sexy investments. They're not going to double in 6 months. But they're the foundation of everything else. And when the financial system reprices around scarcity instead of abundance, the people holding those assets will set the terms. Everyone else will be a price taker. And this is why BlackRock's move matters. Because when the largest aggregator of global capital rotates toward physical assets and policy-dependent infrastructure, they're not making a bet. They're front-running a structural shift they helped design. They're not worried about your future. They're securing theirs. And the gap between those two outcomes is the entire story of the next decade. So here's the real question. Are you positioned for the world BlackRock sees coming, or the world you've been told to believe in? Because those are two different worlds. One is built on productivity, innovation, and free markets. The other is built on central planning, resource control, and currency debasement. BlackRock has already chosen. The only question is whether you'll figure it out before the window closes. The filings are public. The pattern is clear. The math is already locked in. So let me ask you this. If BlackRock knows something the rest of the market doesn't, what sector do you think will be the most valuable in 10 years? Drop your answer in the comments. I want to know if you see what they see.